Ever feel like you're just wading through endless information, hoping for a shortcut? Just, the key stuff without the noise.
Oh, absolutely. Information overload is real.
Totally. Well, today, we're doing a deep dive into something pretty critical. How experts really rigorously evaluate risk. Think complex situations, like in business or finance.
Yeah, it's a fascinating skill.
Our mission for you is to unpack what risk actually means in that professional world. We'll look at different types and, crucially, how the pros spot the really important ones.
Think of it as getting a sharper lens, a way to cut through the clutter you mentioned.
Exactly. A new mental model, maybe.
That's a good way to put it. We'll aim for clear definitions, use some really interesting real-world examples from the source material we looked at.
Okay.
And hopefully give you insights you can apply pretty much anywhere. Risk is a factor. It's about getting that aha moment.
Sounds good. So let's start unpacking. When the experts talk about business risk, what exactly are they zeroing in on, strategically speaking?
Well, it's broader than you might think initially. It's about risks coming from, significant conditions, events, circumstances, and in the company's own actions or lack of action.
Okay.
Things that could stop a company from hitting its goals or executing its strategies. Or, and this is key, it could even stem from setting the wrong objectives or strategies in the first place.
So it's quite fundamental.
Very. It's about the core strategic health, really.
Yeah.
ISA 315 revised actually defines it along those lines.
Interesting. But why do auditors, who we often think of as number crunchers, focus so much on these big strategic business risks?
That's a great question. It's all about the knock-on effects.
Right.
Understanding these strategic vulnerabilities helps auditors pinpoint where the financial statements might be, materially wrong, significantly wrong. Because most business risks, sooner or later, they tend to have financial consequences. They ripple down and impact the numbers you see in the financial reports.
Okay, that makes sense. The strategic connects to the financial. So how do experts evaluate these risks once they've maybe identified one? What's the process? What are they looking for?
Yeah, the evaluation part is crucial. It's not just ticking a box. First, and this is discipline, they only use the information given in the scenario.
No outside knowledge.
No speculating. You stick to the script, basically. Then it's not enough to just name the risk. You have to show its specific impacts on that client.
How it actually affects them.
Precisely. And assess the scale of the risk. Why is it particularly significant for this company? Are there other factors making it worse?
And what does significant mean in this context?
Generally, something with a medium to high chance of happening and having a substantial impact. Importantly, that's after considering any mitigating factors mentioned.
Okay, after controls or actions they've taken.
Yes. And one more vital point. A risk is about an uncertain future event or outcome. It's not a fact that's already happened and been measured.
Like the difference between forecasting rain and being caught in it.
Exactly like that. Risk is the forecast.
Got it. Okay, let's make this concrete. Our source material had a really good example. Winberry Go. A listed food delivery company, all online sales. They had a data breach. How would an expert break down the business risks there?
Winberry. Perfect example. The data breach itself, that's happened. That's the fact. The risks are the potential consequences, the uncertainties stemming from it.
Okay.
So, risk one, the breach becomes public. Obvious impact. Reputation damage, losing customers.
Standard stuff for a breach.
Right, but the evaluation goes deeper. Did they report it quickly? The scenario suggested they didn't. That delay, it could make the reputational hit much, much worse. And here's the commercial acumen bit. Because Winberry is online only, no physical stores. Losing customer trust online is potentially devastating. It hits their entire business model.
Right, they're more exposed.
Hugely. Okay, risk two. They might get fined for the breach.
Financial impact.
Yes. Initially pressure on cash, lower profits, but again, evaluate further. The fines could be higher because of the delayed reporting.
Compounding factors.
Exactly. And a drop in profit isn't just about profit. It could trigger a breach of their banking covenants. Those loan agreements often have clauses about maintaining certain profit levels or ratios.
Ooh, okay. That could be serious.
Very serious. Defaulting on loans is a major problem. That link to covenants, that's commercial acumen, again, seeing the wider financial web.
Right. Any others for Winberry?
Yeah, a third one. The possibility that other data weaknesses exist that haven't been found yet.
The tip of the iceberg idea.
Sort of. The initial impact is the potential for more serious breaches, maybe credit card details, identity theft stuff.
Which would be worse?
Much worse. The evaluation would stress that this means even bigger fines, catastrophic publicity. It escalates the whole thing.
Okay.
This also touches on professional skepticism, not just accepting the known breach is the only issue.
It's fascinating how you're weaving in commercial acumen and professional skepticism there. It sounds like it's not just about theory, but really understanding how things play out in the real world.
That's exactly it. It's what separates a basic analysis from a really insightful one. Commercial acumen is knowing, for instance, that management not reporting the breach isn't just an internal problem.
Right.
It can hammer the share price because investors hate that kind of thing. It erodes trust way beyond just the immediate profit hit. And yeah, understanding those debt covenants or the unique vulnerability of an online-only model, that's practical insight.
So on the flip side, what isn't considered a significant business risk in this expert view? What are common mistakes people make?
Good question. A big one is confusing a fact with a risk. Like we said, the Winberry data breach happened. That's the fact. The uncertain outcomes are the risks.
Don't state the obvious problem as the risk itself.
Precisely. Another is highlighting risks the scenario tells you are already handled.
The mitigated risks.
Right. Winberry had specialized staff for food safety compliance, remember? So while food safety is a general risk for food companies, it wasn't a significant one to focus on here because the scenario said it was managed.
Okay, pay attention to the details provided.
Definitely. And finally, avoid jumping to extreme, unlikely worst-case scenarios. Like saying Winberry will go bankrupt immediately.
Unless there's strong evidence for it.
Exactly. Unless the scenario paints a picture of existing severe financial distress or something similar. Otherwise, it just looks like speculation, not professional judgment. Be realistic.
That's super helpful. Okay, so we've covered business risk. Let's shift slightly. What does all this mean when we talk about risks of material misstatement or RoMM? How does that connect to the actual numbers in the accounts?
Right, RoMM. This is where we get closer to the financial statements themselves. RoMM are, simply put, risks that could lead to a material misstatement, a significant error or omission in those financial statements.
Affecting the numbers people rely on.
Exactly. These can be risks that affect the financials overall or specific accounts like inventory or revenue.
And you mentioned before there are two components, inherent risk and control risk. How do they fit into RoMM?
They're the building blocks of RoMM. Think of inherent risk as the baseline susceptibility of an account or transaction to being misstated before you even consider any internal controls the company has.
So some things are just naturally riskier.
Pretty much. The standards actually point to 5 factors that tend to increase inherent risk. Is it super complex? Does it involve a lot of subjectivity or judgment? Is it subject to change? Is there high uncertainty? Or is it susceptible to management bias or fraud?
Can you give me an example?
Sure. Imagine a company buys a really valuable brand name, a big intangible asset. Valuing that, deciding its useful life. That involves judgment, maybe subjectivity, potential management bias to make it look good, high inherent risk.
Okay.
Contrast that with buying a piece of land, usually that's recorded at cost. Much more straightforward, factual, lower inherent risk. It's a spectrum.
Got it. So that's inherent risk. What about control risk?
Control risk is the other side of the coin. It's the risk that the company's own internal controls won't prevent or detect and correct a material misstatement that could occur.
So it's about whether their systems work.
Exactly. Auditors assess this, especially if they plan to rely on those controls. Back to Winberry, they had perishable inventory, right? That could be a valuation risk, inherent risk.
Things going bad.
Yeah. But the scenario said experienced professionals monitored it. That's an internal control. If that control is effective, it reduces the overall RoMM related to inventory valuation. Control risk is lower.
So good controls can lower the overall risk of misstatement.
Precisely. Same with their food safety compliance mitigating health risks. The controls mattered.
This brings up a tricky point. Once an expert identifies a potential RoMM, maybe something involving judgment or potential bias, how do they evaluate how significant it really is? That sounds complex.
It is complex, and this is where deep understanding professional skepticism really shines. Let's use the Winberry fine example again, but now thinking about RoMM the risk to the financial statements.
Yeah.
First, application of judgment. Should they record a liability, a provision for the potential fine? Accounting rules say you provide if it's probable you'll have to pay. If it's only possible, maybe just a disclosure in the notes, a contingent liability.
A big difference in impact on profit.
Huge.
Yeah.
Now, commercial acumen. Remember we said disclosing the possibility of a fine might actually alert the regulator?
The catch-22.
Right. That disclosure itself could make the fine go from possible to probable, changing the accounting requirement. An expert sees that practical angle.
Wow, okay.
Then professional skepticism and management bias. Why might management not want to record that provision even if it seems probable?
The profit impact. And those covenants we talked about.
Exactly. Lower profit could breach their interest cover covenants. That gives management a motive to perhaps underestimate the probability or amount. Auditors have to be skeptical of that potential bias.
So you challenge their assumptions.
Constantly. Then you assess the scale and impact. If they don't make a provision when they should, profit is overstated. And the fine could be higher due to the non-reporting. That potential covenant breach makes even a smaller misstatement potentially material by nature, significant regardless of size because of its consequences.
And it links to wider issues.
Definitely. Management's failure to self-report the breach. That raises questions about their integrity overall. If you start doubting management's honesty, how reliable is anything they tell you? It impacts the trustworthiness of all their explanations and evidence.
That really paints a picture of how deep this evaluation goes. So connecting all these threads, business risk, how does audit risk fit into the final picture?
Audit risk is the umbrella concept. It's the overall risk that the auditor expresses the wrong opinion, like saying the financial statements are fine when they actually contain a material misstatement.
The auditor getting it wrong, basically.
In simple terms, yes. And it's defined as a combination of the risk of material misstatement, made up of inherent and control risk, and detection risk.
Okay, what's detection risk?
Detection risk is the auditor side of the equation. It's the risk that the procedures the auditor performs will fail to detect a material misstatement that actually exists.
So the risk that our work doesn't catch the error.
Exactly. It's the risk we miss something important.
And are there times when that detection risk is higher?
Oh, yes. Several situations can increase it. New audit clients, for instance, we just don't know them as well yet.
Less background knowledge.
Right. Or in group audits, if we have to rely heavily on the work of other auditors for subsidiaries or components.
Trusting someone else's work.
Also, if the audit firm's own quality management isn't great, or if there are ethical threats like lacking the right expertise for a niche industry, or facing intimidation from the client, or having a self-interest threat, these can all stop the team getting the right evidence.
Yeah, I guess.
And fundamentally, a lack of professional skepticism by the audit team itself. If the team isn't challenging, isn't probing, they're much more likely to miss things. Detection risk goes up.
It really sounds like there's so much more to this than a simple checklist approach. What are those professional skills that really make the difference? The secret sauce, maybe.
Yeah, the secret sauce is a good term for it. It's definitely beyond just the technical rules. The source material talks about professional marks, things like analysis and evaluation. That means not just listing risks, but really prioritizing which ones are most significant and crucially, why. Is it the likelihood, the potential size of the impact?
Making reasoned choices.
Exactly. Then there's professional skepticism and judgment. This is the mindset, actively questioning management's choices, especially on accounting matters, drawing your own conclusions about why a risk matters, and like we discussed, sniffing out those potential management biases or motives.
Being constructively critical.
Yes. And finally, commercial acumen, that real brain savvy, understanding how business works, knowing that an online-only model has specific vulnerabilities, or that internal monthly accounts might not be as robust as year-end ones. It's about context.
So it's that depth, that tailored thinking.
Absolutely. It's about the depth of evaluation, applying that what implication thinking to the specific facts of the case, not just giving generic, brief answers. That's where the real value lies.
What an incredible deep dive today. Seriously, we've gone through business risk, inherent and control risk combining into RoMM, overall audit risk, and crucially, the professional skills like judgment, skepticism, and that commercial acumen that tie it all together.
It's been great. And hopefully you can see how using precise definitions, evaluating risks within their specific context, and having that keen eye for underlying factors like bias or business models is so vital. It goes way beyond a surface glance.
So thinking about everyone listening, what does this all mean for you?
Well, maybe consider how these core principles apply outside of auditing. Identifying what's truly significant, assessing likelihood and impact even after mitigation, applying that healthy professional skepticism.
How could understanding these rigorous approaches help you evaluate information or assess risks in your own world? Could be a big work project, a personal investment, a career move.
Or even just reading a news story. It's all about looking beyond the surface, asking probing questions, digging a bit deeper. You might just find yourself evaluating things with a whole new perspective.